Welcome to HouseLux Estate, the prime destination for those seeking to navigate the world of real estate investment successfully. Today, we are setting sail on a voyage of discovery and learning. Our compass? The most common investment mistakes and how to avoid them. Navigating the unpredictable seas of investment can be challenging, and it's easy to veer off course. That's where we come in. HouseLux Estate is your guide, your compass in this vast ocean of possibilities. We are here to shine a light on the pitfalls and the perils, the blunders, the errors that lurk beneath the surface. Our mission? To provide you with the insights, the knowledge, and the strategies you need to successfully chart your course in the real estate investment world. So buckle up as we delve into the most common investment mistakes and how to steer clear of them. Starting with our first common mistake, not doing enough research. Research, the not-so-secret key to successful real estate investing. It's akin to the compass guiding a ship. Without it, we're simply adrift in a vast ocean of potential blunders. So, what happens when we skip this crucial step? Well, the potential consequences are numerous. For starters, we could end up overpaying for a property. Picture this. You found a beautiful house, the price seems right, and you dive in head first, only to discover later that similar properties in the vicinity are selling for much less. Ouch! That's a stinging pinch to your investment returns. Or perhaps you've invested in a property situated in a not-so-desirable location. Sure, the house might be a gem, but if it's surrounded by falling property values, climbing crime rates, or a shrinking local economy, then it's akin to a diamond in the rough. Valuable, but not quite the glittering success you envisioned. So, how do we avoid these pitfalls? The answer is simple: thorough, meticulous research. This means getting down to the nitty-gritty of market analysis. Understanding property values, rental rates, and local economies is paramount. Think of it as a detective's job. You're piecing together a puzzle, looking for clues that will lead you to the perfect investment. Look at market trends, investigate neighborhood demographics, study the local economy, scrutinize rental rates, and analyze property values. But it doesn't stop there. Go a step further. Talk to local real estate agents, property managers, and even residents. They're the ones with the boots on the ground, and they can provide invaluable insights that no amount of online research can match. In the end, it all boils down to one simple fact. In real estate investment, knowledge isn't just power. It's your lifeboat in the stormy seas of investment. It's the tool that will help you navigate through the complexities, avoid the pitfalls, and steer you towards success. Remember, in real estate investment, knowledge is power. Moving on to the second common mistake, lack of diversification. Picture this. You've gathered all your eggs, painted them in beautiful hues of your hopes and dreams, and then you place them all in one basket. Sounds like a risky move, doesn't it? This is exactly what happens when you invest all your money in one type of property or one geographical location. It's like betting on a single number in a game of roulette. Sure, the payoff could be enormous if you get lucky, but the odds are heavily stacked against you. The real estate market, much like any other investment market, is volatile and unpredictable. A single economic downturn, natural disaster, or market crash could wipe out your entire investment. Now, let's imagine a different scenario. You have the same basket of eggs, but this time you distribute them across several baskets. Some are in the city, some in the suburbs, some in commercial properties, and others in residential properties. This is what we call diversification. By spreading your investments across different types of properties and geographical locations, you're essentially hedging your bets. If the real estate market crashes in one location, your other properties can help cushion the blow. If the commercial sector takes a hit, your residential properties might still be thriving. It's a safety net that can save you from the pitfalls of putting all your eggs in one basket. In addition, diversification can also increase your potential returns. Different types of properties and locations often perform differently at the same time. While some might be experiencing a downturn, others could be on an upswing. So, by diversifying, you're not only protecting your investment, but also increasing your chances of reaping higher returns. But remember, while diversification is a powerful tool for risk mitigation, it's not a guarantee against losses. It's still crucial to conduct thorough research and make informed decisions when choosing where and how to diversify. As the saying goes, don't put all your eggs in one basket. Our third common mistake is investing without a plan. Imagine setting out on a journey with no destination in mind. You might find some exciting detours along the way, but without a clear endpoint, you'll likely end up wandering aimlessly. The same goes for investing. Diving into the investment pool without a clear strategy is like setting sail in uncharted waters without a compass. Sure, you might stumble upon a treasure island by chance, but chances are you'll end up lost at sea. This is the pitfall of investing without set goals and a roadmap. Investing is not a gamble you take on a whim. It's a calculated risk. It's a strategic game where the players with the best plans often come out on top. Therefore, having a well-defined investment strategy is paramount. Let's think about it for a second. Would you build a house without a blueprint? Probably not, right? Then why would you invest your hard-earned money without a plan? Investing without a plan is like building a house without a blueprint. You might get the walls up, but the lack of a solid foundation could cause the whole structure to collapse. So, how can you avoid this mistake? The solution is simple. Create a detailed investment plan. This plan should outline your short-term and long-term goals, your risk tolerance, and your exit strategy. Short-term goals could be things like generating a certain amount of income within a year. Long-term goals, on the other hand, could be about growing your wealth over a decade or more. Your risk tolerance is essentially how much loss you're willing to endure before you bail out. And your exit strategy? That's your plan for cashing out when things don't go as planned or when you've reached your investment goal. Creating a detailed investment plan might seem like a daunting task, especially if you're new to investing. But fear not, there are plenty of resources out there to help you. Remember, the most successful investors are not those who make the most daring moves. They are those who plan their work and work their plan. To succeed in real estate investment, plan your work and work your plan. Last but not least, our fourth common mistake, overleveraging. Overleveraging, simply put, is the act of taking on too much debt. While leveraging can be an effective tool in real estate investment, it can also be a double-edged sword, if not handled judiciously. Consider this scenario. An investor takes out a large loan to finance multiple properties. The idea is to repay the loan using the profits generated from these properties. But what happens if the expected profits don't materialize? Or what if the real estate market takes a downturn? Suddenly, the investor is left with hefty loan repayments and little to no income to cover them. This is the risk of over-leveraging. It's like walking a tightrope without a safety net. One wrong step, and you could find yourself in financial distress. And in the worst-case scenario, you could end up losing your properties altogether. Now, this doesn't mean you should avoid leveraging altogether. Quite the contrary. Leveraging, when used correctly, can be a powerful tool. It can help you acquire properties that you might not have been able to afford otherwise. It's all about finding the right balance between risk and reward. So, how can you avoid over-leveraging? First, it's important to have a clear understanding of your financial situation and risk tolerance. Know how much you can afford to borrow and repay. Second, have a solid investment strategy in place. This includes having a thorough understanding of the real estate market and the potential profitability of your properties. Third, always have a contingency plan in case things don't go as planned. In addition, consider seeking advice from financial experts or seasoned investors. They can provide valuable insights and help you navigate the complexities of leveraging. Remember, in real estate investment, it's not about how much you own, but how much you owe. Over-leveraging can turn your investment dreams into nightmares. But with careful planning and a balanced approach to financing and leveraging, you can steer clear of this common pitfall. In real estate investment, balance is key. There you have it, the most common investment mistakes and how to avoid them. We've navigated the pitfalls of not doing enough research, where the key is to delve deep and understand your potential investment inside and out. We've explored the dangers of lack of diversification and stressed the importance of spreading your investments across different asset types and sectors. We've highlighted the risks of investing without a plan, emphasizing the necessity of having clear, defined goals before embarking on your investment journey. Lastly, we've discussed the perils of over-leveraging and underscored the need for a balanced approach to borrowing. Remember, success in real estate investment doesn't come overnight. It requires patience, diligence, and most importantly, learning from the mistakes of others. By sidestepping these common pitfalls, you're positioning yourself for a brighter, more prosperous investment future. Thank you for tuning in to House Lux Estate. Don't forget to subscribe for more insightful real estate investment content. Until next time, invest wisely.